Manny Apollonio. I'm a certified financial planner professional, and I'm also a financial life coach. In every video, I share 5-minute insights in the area of personal finance and personal development. I truly believe that leveling up your relationship with money and success is the true path to financial independence. It all starts with mindset. So let's dive into today's topic. Today's topic is financial housekeeping. What does that even mean? Well, often my new clients are coming to me because they're living in confusion around their financial life. One of the first things I do is I try to clean up their finances by consolidating as many accounts as I can. So that starts with asking the clients to consolidate their accounts so they have less visual noise. Part of financial maintenance avoidance begins with this confusion. So if we can clean things up so there's less confusion, it makes the task of maintaining their finances easier. So if the task of going into your financial accounts is cumbersome and confusing, you're not going to want to look at it. In my experience, the goal is to create an elegantly simple financial life. For example, I tend to have clients in their 30s or 40s who have worked at this point in their careers at several jobs. They were diligent and they participated in their company's retirement plans like a 401k or 403b. For example, the typical millennial changes jobs more often than perhaps the generations before us did, so it's likely there is a collection of these retirement accounts strewn about different financial institutions. My goal for most clients is to get them to consolidate as many of their brokerage accounts into one institution or to have just one login. Obviously, there are some limitations to this, especially if you're currently employed and putting money into a 401k. If that's the case, you're pretty much stuck with the financial institution your company has hired to manage your 401k. You can't do much with that 401k so long as you're an active employee with that firm. But when you retire or exit that firm, you have the ability to roll your 401k into an individual retirement account. The IRA allows you to preserve the tax benefits that 401k monies already enjoy or have already been granted. The IRA can be held at most of the popular brokerage firms or fund companies for no fee. Step one in most cases is to consolidate all of the retirement assets into one account. Obviously, however, you don't want to commingle IRA assets with Roth IRA assets, or for example, your pre-tax 401k assets can roll over into an IRA. Additionally, if you have an IRA at one firm or one financial institution, let's say you have one at American Funds, you can consolidate that with an IRA at Charles Schwab. Some firms will not let you hold specific assets. Sometimes if they're competitors, for example, they won't let you hold those assets. In that case, you're going to want to sell the position at the existing firm and then transfer over the cash. Now, this is a non-taxable event, so long as it happens inside an IRA. There's nothing that says you can't later on buy a similar asset in the new IRA once the cash has been transferred over. So remember, you do not have to worry about capital gains in retirement accounts because you are taxed on those assets only when they are distributed to you. In that case, it'll show up on your 1099-R, which is the tax form you'll receive at the end of the year, typically around February. In your 1099, it'll be coded in a way that will require you to include the distribution amount into your current year taxable income. So as we consolidate your assets, you might still receive this 1099-R, but it will be coded as a non-taxable event, i.e. a rollover. This is important because a distribution, not a rollover, of your 401k assets can be recorded as a taxable event, thus putting you on the hook to pay some income taxes on the distributed amount. If that happens, you have 60 days to move those assets into a qualified account for it not to be counted as income in that same year. Some employers will automatically convert your former 401k assets into an IRA. Other firms will just allow former employees to maintain their 401ks. The advantage of consolidating is to reduce visual clutter. You'll have less statements, less logins, and less passwords, and less confusion about what is where. So when you move assets of your 401k, it's typical that the financial institution will either issue a check directly to the new institution that will now custody your IRA. Custody is a fancy word to say will hold on to and will account for the taxes. Anyway, your IRA or your new employer's 401k. So the check will go from your old institution into the new institution. It all kind of happens behind the scenes. Although you can, most of the time, roll your old 401k into your new employer's 401k, I usually advise against it because you have greater control of your investment selection in an IRA. The exception to this advice is when I know a client is planning to do a 401k loan. In this strategy, the 401k owner is able to essentially borrow against their own account. And the maximum you can typically borrow is 50% of the balance, up to $50,000, but I digress. In this financial housekeeping phase, I want clients to reduce the number of accounts they have, so they have less that they need to keep track of. Another thing to consider for those of my clients that were awarded incentive stock compensation, if you are no longer employed at the firm that awarded you that incentive stock, you most likely no longer need to maintain a brokerage account with that firm that you started out with. So you can consolidate those assets into your taxable brokerage account. If you already have an IRA with one firm, you might consider bringing your taxable brokerage account to that firm as well. Again, reduce the noise by consolidating financial institutions whenever possible. Side note, there's this misguided perception that having accounts at multiple different firms, all practically doing the same thing of custodying your assets, is somehow a hedge against risk. This is not what we mean when we say diversify. You want diversity in the different asset classes, not financial institutions. This being said, you can achieve a high degree of asset class diversification even within one institution, even within one mutual fund. So it's not necessarily the number of accounts and where you have them, it's the quality of the investments you have in that account that matter. The added benefit of being able to see all your assets in one place makes reviewing your financial information that much easier. Therefore, you're more likely to do it because now you understand it. Thank you for watching my 5-minute personal finance level up video. If you like this video, please give me a like and be sure to subscribe so that you can receive an update when the new video comes out. Your support helps me to keep this endeavor profitable so I could bring financial planning advice typically reserved for the top 5% to more folks. Anyway, thanks again for being here, and remember that I wish you prosperity in all things today and every day. I'll see you next time.